All right, amen, hallelujah. Chapter 11, Stockholders' Equity, the last stop here. Um, we are going to be reviewing some of the characteristics of a corporation and some additional information from Learning Objective 1 that's important. Learning Objective 2, the concepts you're going to be learning about, if you've already heard about common stock, you might not know much about preferred stock, but that is also another um, concept you need to know. You're also going to understand when a company buys back its shares, that's called Treasury Stock. So we're going to learn a little bit more about that. Learning Objective 3, we're going to focus on simply the most common type of dividend that's paid, which is a cash dividend. There are lots of other types, but we're only going to focus on the cash dividend. And then the last part here with Chapter 11, Objective 4, we're just going to look at the balance sheet to make sure you can read the stockholders' equity section and a little bit of analysis. And we're done. So a corporation is, it's created by the state. States have jurisdiction of business law. And so when you want to become a corporation, you need to apply. There's an application process through the state. Since there are 50 states, you really have your choice in where you want to incorporate. Just because you are headquartered in New York doesn't mean you have to apply to become a corporation in the state of New York. You can apply in any of the states that you wish. Um, the application process is very specific. You have to tell them what the purpose of the corporation is. Corporations are artificial legal beings, and so they can exist for a number of different reasons. Our focus, of course, is the purpose of a corporation is to set up a for-profit business. But that's not the only purpose of some corporations. Many corporations are started for not-for-profit purposes, such as a lot of colleges and universities are not-for-profit corporations. So they're mission-based. They're mission-based. You have a lot of religious organizations, be it churches, synagogues, mosques, etc., that are organized as well. They're probably organized as not-for-profit corporations. You can be a philanthropic or social or other entity and be organized as a not-for-profit corporation. So whether that's a YMCA or your local, Poughkeepsie Baseball League, you can be organized for purposes other than profit. Of course, for our discussion, we're going to focus on a for-profit corporation. One thing that you have to understand is corporations, as you know, the ownership of a corporation is broken into shares of ownership. The question then becomes who can own the shares of ownership. As corporations start, all those shares are considered what we call privately held. And so that means that the shares of ownership in a corporation are held by usually just a few people, normally speaking, and so that it's private information. A privately held corporation simply means that whatever is happening in the corporation in terms of its revenue, its profitability, assets it has, debts it has, is simply the private information for the owners. Okay, you might not have heard of Cargill, which is an agricultural company, but I'm sure you've heard of Bose because they make so much great sound and other acoustical equipment. They're often put into high-end automobiles, etc. If you watch the Super Bowl or any football game, you'll notice all the coaches have Bose headphones and microphones on. Bose is a very large, worldwide, it's a global corporation, but it's a privately held corporation, which means the shares of ownership in Bose are held by a group of private individuals, including the late Dr. Bose. He passed a couple years ago. his family, his associates, they own all those shares of ownership. They own all the shares of stock. So in terms of what's our business, there's not much that's our business. We don't know what the revenue was of Bose. We don't know what the profitability is of Bose. We don't know what assets they have. We don't know what debts they have, et cetera. Why? Because we can never be owners in Bose. It's a privately held. The shares of ownership are not for sale to you and me. When a company decides they want to raise, usually it's when they want to raise a lot of money, a lot more than a privately held corporation usually can, they go through a process of going public, which basically means they're changing their ownership from a privately held company to a publicly held company. So the word public simply means that anybody in the public could be an owner of the corporation. And so you and I could be owners of corporations only if they are publicly held corporations. So a publicly held corporation, everything changes. It now becomes everybody's business. And so the Securities and Exchange Commission, which is a part of the government, the United States federal government, is the agency that's in charge of monitoring publicly traded companies and other securities that are associated with that. The reason you and I have been doing this book and we've been learning about generally accepted accounting principles is because the information that's provided by these statements are for the public. You've been learning about generally accepted accounting principles because the whole book is based not just on the corporate form of ownership, but for public corporations. What's required of public corporations to make sure they go through this process so the information that's available to the public is as accurate as possible. All those rules that we've been learning is really because the corporation is publicly owned, publicly traded. That's the other reason we know everything about certain companies and very little about others. So we know that Mark Zuckerberg is worth X number of billions of dollars because as the chairman of Facebook, he has to publicly disclose how many shares of ownership he has in the company. And we know what the price of a share of stock is because it's traded on the exchange. So it's simple mathematics. There's the number of shares he has times the amount that each share is worth. Boom, guy's worth 30 million, 30 billion, 40 billion, $50 billion. It's an easy calculation because it's all public information. It's much, much harder to do that for companies that are privately held. And so, because it's really, we have to guess, because a lot of information is not our business because it's not a public company, it's a private company. And so that ownership piece is really important. The book that we've been using is really about public corporations. That's why we've been learning GAAP. Okay. This is where the repeat is from chapter 1. We've learned about the forms of business, sole proprietor, partnership, and corporation. And this reiterates again some of the advantages and disadvantages of the corporate form of business. Okay, so let's take a quick peek through these again. Number one, because a corporation, you have to apply to become a corporation. Once the state approves that, the corporation itself becomes a separate legal entity under the law. That's not true of a sole proprietor or partnership where there's no difference between Mike Arujo, the person, and Mike Arujo, the business under the law. And so if Mike Arujo does anything wrong, Mike Arujo is going to get sued. All of Mike Arujo is going to get sued, both the business part and the personal part. For a corporation, they're a separate legal entity. And so the corporation is in of itself separate from even the people who have started it and run it. Okay. And that's very important distinction. Another advantage is that if I were as a sole proprietorship, knowing that under the law, there's no difference between me, the person, and me, the business. Everything that my name is on, whether it's a house, cars, savings account, all of that is at stake because I, the person, am getting sued for something that I might have done wrong. As a corporation, the owners of a corporation, stockholders, have a limited liability in the worst case scenario that the corporation does something terrible and is sued practically out of existence. They are limited. The most they can lose is whatever they put in. So if I settle a corporation for $10,000, I put $10,000 in cash in, that's how much my stock is. That's it. That's all I can lose if things go belly up. That's not true if I were a sole proprietorship. I could lose a lot more. Okay. Another thing that's very interesting, that's a big plus for corporations, is ownership can be transferred quite readily. That's the only thing that's happening on the stock exchange every day, by the way, is shares of ownership are being traded. Okay. Which means certain people that own the corporation are selling those shares to people who want to buy those shares. That's it. So owners are being traded all the time, but nothing happens to the corporation, which is really, really important. And that's because the ownership of a corporation and the management of the corporation are separate. Okay, that's a unique thing about a corporation that doesn't happen to sole proprietorships or partnerships. Another thing that's important is when you're a corporation and you decide to sell a lot of shares, you can raise a lot of money, and that's what's really important to sort of understand. One of the big pluses of a corporation is the ability to raise a lot of money by issuing shares of ownership. Corporations are, like I said, they're separate legal entities, and so they can exist long, long beyond the lifespan of the people who started it, right? Ford Motor Company is still in existence today. Henry Ford's been pushing up daisies for quite some time. However you believe what happened to Walt Disney, either he's dead or frozen or whatnot, Walt Disney Corporation is much larger. I think if he did ever wake up or was defrosted, I hate to see what that looks like, but he probably wouldn't recognize his company at this point because it's simply continuous life. Steve Jobs is dead. But okay, but of course, Apple still runs, right? So continuous life is interesting. Corporate management, this is both a plus and a minus because that separation of ownership and management allows things to be very consistent, very, very consistent. So for example, if I own a business and I sell it to someone, everything changes, right? And the management changes, everything changes. My ownership and the fact that I'm running the business is equal. For a corporation, the stockholders are the owners, but they're not the managers. They're not the managers of the company. Management is separate. So that means, today, perhaps several million shares of stock have traded in McDonald's or Walmart, but nothing has changed the individual management of those companies because the ownership and the management are separate. Government regulation is considered somewhat of a disadvantage here. It really kind of depends on how you look at it, like life, right? Because when the federal government or the state government usually pass laws, oftentimes the corporations are the ones who bear much of the brunt of that. And so, for example, yes, prior to the 60s, there was no customer service. So if you bought a product from a company and it didn't work, they had no obligation to even acknowledge or talk to you. Oh, well, be careful with your money. Buyer beware, where that usually came from. But because Congress passed in the early 60s consumer rights and consumer protection, and states followed up with more. Now, corporations have to set up customer service departments and other things to take care of these types of issues. So yeah, they have to spend money setting up a department, and that's true. That's a disadvantage. But they shouldn't be screwing you don't want to screw your customers anyway. But so I mean, it's kind of a mix. Same thing with civil rights, human resource type things. You know, when back in the 50s and 60s, when you just walked up and said, you know, are you hiring? And they said yes or no. Um, Today, of course, you know, and that would mean that if you were, you know, generally, if I walked up there, I'm a white guy, they're going to say, okay, yeah, sure, you can start tomorrow. But what if I was black or dark skinned or, you know, and they didn't like me? No, we don't have any jobs available today. That kind of happened. So yes, discrimination laws, other things are on the book. It spawned the whole field of human resources. Um, but I think again, even though it's a government regulation that forced corporations to spend more money on doing that, they shouldn't have been doing that in the first place. So again, yeah, part of it is it's good and bad. You know, I mean, it's a disadvantage, yes, but they shouldn't have been doing it, right? So yes, government regulations do force them to spend money, but to me, so what? Additional taxes. This is a disadvantage because of two things. One is if a corporation has a profit, they pay income tax on that profit. But then what else can they do with that profit? Sometimes they share that profit with the owners in the form of a dividend. Well, the owners have to pay taxes on those dividends. So they consider that like a double taxation or additional taxes, and it's considered a disadvantage. Corporations are structured with the owners certainly on top. And as you see here is the management of the company. They are separate. They are separate. So who represents the owners? Who hires the management? It's the board of directors. The stockholders vote for a board of directors of their corporation. The board of directors are supposed to create broad policies that make the owners wealthier. It's also the board of directors that hires the upper management, so the president, CEO, all the VPs. They hire the management team to get it done. To get it done. So that's how that structure works in general. There are lots of other forms of businesses that we're not going to get into. Your book does recognize there are LLCs and LLPs and things like this. All I can say in general is you're going to get more detail on this in business law too, if you take that class. But these are all hybrids, meaning they're part partnership and they're part corporation. The benefits of a partnership with the benefits of a corporation are sort of melded together in this recipe to create all these other different types of business organizations. Again, to start a corporation, you need to apply. The application can be filed with the state. Every state has a state government, as you know. Governor's the head of that. There's a lieutenant governor. There's a treasurer. There's an attorney general, and there's a secretary of state, among other officers. The secretary of state for the state is in charge of corporations in this case. So you apply. There's an application process in which you apply. It goes to the Secretary of State of your state. They review it for accuracy, making sure it conforms with their requirements. Once it's approved, that application becomes what's called a corporate charter, which means this basically creates the artificial being under the law. Now this corporation is a real artificial being under the law. And so that's really important. You have again, you can incorporate in any state you want. Some states like Delaware have some laws who are quite favorable to the corporate form of business. So Delaware tends to get a lot of companies who incorporate in that state, even though they're based in other states. regardless if you're doing any business in any other state outside of the one you're incorporated in, you need to get a license from that state to register that you're doing business in that state. So stockholders have certain rights. If you're an owner in a corporation, you have certain rights. The big rights are right up front. The right to vote for the board of directors. That's really very important for stockholders. It's egalitarian, one vote, one share, one vote. If I have 100 shares, I have 100 votes. If I have 10 shares, I have 10 votes. If I have one share, I get one vote. One share, one vote. The second type of right they have is they have a right to share. It's not a guarantee, it's a right. Okay. You right to share in the earnings of the company in the form of a dividend. And so that's another very important right that shareholders have. Another right that a shareholder has is they have a right to keep their ownership the same as more shares get issued. So let's say there's a company now that has 100 shares and I have 14 of those shares. So I have 14% ownership in the company. The company wants to issue another 100 shares. Well, I have a right to keep my ownership at 14%. So I have a right to buy the shares first to keep my ownership the same. I can forfeit that right, but I have the right to keep my ownership the same. And the last right really is not something you want to happen at all. It's because the business went out of business, corporation's out of business. A liquidation is basically when a court requires the corporation to sell all of its assets. Okay. What happens at that point is the creditors get paid first. So if you loaned money to that corporation, you're first in line to collect from any monies that have been collected from the sale of their assets. If there's any money left over, it goes to stockholders. That's what a residual claim is. But I will tell you, if this is happening, there's nothing left over. This is what a stock certificate looks like. These are all registered securities, so your name and information would be front and center. The number of shares you own, and of course the name of the company, all listed here. It is an official, but it's very rare that they're actually printed now. They're usually electronic. So let's go back to that application where it gets approved. Part of that application is asking the state to recognize your ownership. The basic ownership in a corporation is 200 shares. That's in the state of New York, it's 200 shares. So that means if you just fill out the application as is, the state will recognize your corporation as having 200 shares of what we call authorized stock. So it's a legally recognized stock, shares of stock your corporation has based on your application. You can have as many shares of stock as you want. You just have to apply for it. 200 is the base. And every time you go up for 1,000, 2,000, 3,000, there's additional fees that the state charges. But you can have 200 shares, 200,000 shares, 200 million shares. It doesn't really matter. You just pay the appropriate fee. Authorized stock again. So that legally recognized stock that came with the application for your company. So that's important to know. That you have to know. So now that you have been approved as a corporation and you have this authorized stock, you should decide how much of it to sell to raise money. To sell shares of stock is what issued means. So an issued share or issued stock is how much stock you've sold, how many shares you've sold. You sell it to investors to raise money. That's the whole idea. Okay. So corporations can sell common stock directly to the investors, which is quite common in terms of what happens in most corporations. Most corporations are private. Most corporations are small in that regard. Or corporations can hire an investment banking firm Investment banks basically help corporations and governments, by the way, raise money, raise money, either through issuing stock or bonds. Okay, so they are sort of the fundraisers of capitalism, investment bankers. So they can issue stock indirectly through investment bank company. Assuming the corporation is public, meaning anybody in the public can be a stockholder. Once the corporation sells its shares of stock either to investors or through an investment bank, other people can buy them on the exchanges. Um, each exchange is quite different in the sense the New York Stock Exchange is sort of the big kahuna here to some degree. But you have to, in order to be a stock or a company listed on the New York Stock Exchange, you've got to be pretty damn big to start with. For a lot of other companies that are just starting out or a little bit smaller, they're all going on the NASDAQ. The NASDAQ is the sort of electronic exchange, even though it has a very large building in New York City. It's just a building full of computers. The NASDAQ is an electronic network of brokers. The New York Stock Exchange also has the same type of electronic interaction and network of brokers, but they literally have a physical trading floor, and you've seen that probably in watching TV or one of your history classes. They might have shown the floor of the stock exchange. New York is considered sort of a center of that. In Europe, it's the London Stock Exchange is considered one of the centers. In Asia, it's in Tokyo. Euronext as actually New York Stock Exchange has merged with Euronext, and Euronext are some of the larger stock exchanges in Europe, such as the one located in France and Germany, for example. Okay, so once you have this stock that has been authorized, which is legally recognized, and you decide to sell some of that stock, issue some of that stock to investors, you have to do some accounting on it. You have to keep track of that. So what a lot of companies do is use an artificial value they call par value. The par value is simply used for accounting purposes on the balance sheet, as you will see very soon. Okay. Some states do not require a par value, so they will use what's called a stated value. But either way, whether it's a par value or a stated value, the purpose of that is to show what the core legal capital is of the company based on its common stock. And you'll see that on some of the balance sheets I'm going to show you. I'll point it out again. So let's go to the stockholders' equity section of the balance sheet to show how corporate capital is structured. Well, we've been talking about a stock. Stock is considered what we call paid-in capital. Now, this is interesting, right? Paid in. So imagine physically paying in. Well, that's exactly what stockholders do. All companies have what we call common stock or common ownership. And how that works, as you might have guessed by now, is the company sells shares of stock in exchange for cash. So in essence, the owners are paying in cash to the company, and they're getting shares of ownership in exchange for that. That's the paid in part. Some corporations, not very many, very few in fact today, some corporations decide to sell, in addition to the common stock, they'll sell a special type of stock called preferred stock. They call it preferred for very odd reasons. It's preferred to the corporation. Why so? Preferred stockholders do not get a right to vote. Okay. Common stockholders have that right to vote. However, preferred stockholders are promised a dividend paid to them first before the company pays common stockholders a dividend. So that's basically they're accepting a little bit of a legal bribe. You're not going to get a vote, but if we do pay dividends, you get the dividend first. So that's the deal with preferred stock. All companies have common stock. Only a few, about 8% of public companies have preferred stock. In addition, it's addition. Now, remember, I mentioned, we talked a little bit on the last slide about a par value or a stated value. That's what we're going to use. And par values are usually quite low. So that's a penny, a dollar, what have you. I'm going to say the par value of a common stock is a dollar. And that's pretty normal to have a low par value. That's because when a company raises money, based on the number of shares that they've raised, they'll put the first dollar of every share of stock in the common stock account. They'll put all the other dollars they raised from common stock above a dollar into something called a paid-in capital in excess of par. So for example, if they sold one share of common stock for $10, okay, the first dollar would be credited to common stock. The other $9 of the 10 would be credited to paid-in capital in excess of par. That's all they do, is sort of split it up for accounting purposes. Okay, so that's all they're doing here, as you'll see. Preferred stock tends to have a par value of $100. It's very common to have a par value of 100. So it would work the same. Let's say they sold preferred stock, a share of preferred stock for $110. The first $100 would be credited to preferred stock because that's the par value. The other $10 would go into paid-in capital in excess of par. That's all. It's just for accounting. That's the important thing. The other source of equity, as you know, in addition to paid-in capital, is retained earnings. And we've talked about the common stock and retained earnings since the first chapter, really. Retained earnings is the amount of profit that's been retained, right? The profits are owned by the owners. So retained earnings is a stockholders' equity account, all right? So again, just know what those accounts are and how they work. The do it exercise for number one is just a true false statements on the features of a corporation. Pretty straightforward. Let me introduce a little bit more detail on the accounting for common stock. I won't do so much on preferred, but I will show you how treasury stock works. That's also very important. So I mentioned it earlier, accounting for common stock requires them to look at the par value of the common stock and set that up. So here's the assumption here. It's best just to show you an illustration. We have Hydroslide Incorporated. They issued 2,000 shares of $1 par value common stock. So the common stock has $1 par value. This is the accounting value of the common stock on the balance sheet. So when you see par value, think, okay, that's the value on the balance sheet. So what if they, what would be the journal entry if they issued 1,000 shares at $1 per share? So $1 per share is how much they collected on 1,000 shares. Well, $1 a share is the exact same as the par value. So all of the money would go into the common stock account. So they raised $1,000 and it's all going into the common stock account because the price they raised is equal to the par value. But in part B, what happens if they sold another 1,000 shares, but this time they got $5 a share? Well, the first dollar of that is par value for common stock. All the other money is in excess of par. So how you would note this is they get $5,000 of cash. The first dollar is going to be credited to common stock. because that's the par value. All the other dollars, $4 per share, is going to be credited to the paid-in capital account for $4,000. So again, they raised $5,000 in cash, but for accounting purposes, they split it into the par value for common stock, and everything above that is paid-in capital in excess. You have to understand how they break it up. Okay. So how it looks on their balance sheet for what just happened, they had paid-in capital, so common stock is at par value. And then they have the paid-in capital in excess of par. Okay. So that's just something you're going to see on every balance sheet for a corporation. Okay. And of course, retained earnings will be separate. Paid-in capital is always the first section. Retained earnings is always the last section here. Okay. We don't have to worry so much about preferred stock, but it works the exact same way. Preferred stock has a higher par value. They don't get a right to vote, but they get dividends first. And if they do, if the company goes belly up, if there's anything left over, preferred stockholders get it first, but no voting rights. No voting rights. So here we have a corporation that issued, remember, to issue is to sell 10,000 shares of their preferred stock. Now here, their preferred stock has a $10 par value, but they sold them for $12 per share. Okay, so 10,000 shares at $12 a share is $120,000 in cash. Okay, however, this is $10 par value. So the first $10 of that has to go to the preferred stock account. The other, which is $2, will go to the paid-in capital in excess. So again, they raised $120,000 in cash, and they simply break it up. How much of that is the par value of the stock? How much of it is excess? That's all you got to remember. Okay. Corporations sometimes buy back their own shares. That's called treasury stock. Okay, so we're going to learn a little bit about treasury stock. So again, and you might have heard a lot of corporations buy back their own shares. First of all, they have to buy them from shares that have already been sold, that have already been issued. They can't just take it right out of authorized stock and keep it for themselves. They can't do it that way. The rules are that has to be issued first, which means they've sold it to investors, and that can be bought back by the corporation as treasury stock. Okay. The best reason corporations buy their own stock is because they've promised their managers, usually their management, stock options, stock compensation, bonuses, other things like that. So in order for a corporation to give its managers shares of stock, it has to own it first. And the only way they own it is to go and buy it. Okay, so that's important to know. There are other reasons why they buy their own stock, but the most reasonable one is number one. So interesting how we look at when a corporation buys its own stock, we record it at whatever it costs them. Okay, so whatever it costs them to buy the stock. The interesting thing is the treasury stock account is your first known contra equity account. Okay, in other words, common stock, preferred stock all have credit balances. Treasury stock has a debit balance. Okay, it's a contra equity account. And as such, it actually, treasury stock sort of takes away from stockholders' equity. When a corporation buys its own shares, they forfeit all the rights that stockholders have. They do not have a right to vote. They do not have a right to a dividend. Treasury stock is basically dead stock in terms of rights. They're not entitled to anything. Okay, very important. And that's one of the other reasons that we subtract it out of stockholders' equity. So follow me here, because this is important, on how to read a balance sheet regarding this. Okay. So here we have Mead Incorporated. They have common stock with a $5 par value. Okay, that's how they're keeping records. 400,000 shares have been authorized. Remember, the word authorized meant approved with their application. So these are the legally recognized shares, authorized shares. How many of those should they sell? Well, that's the issued shares. They have decided that 100,000 of those shares will be sold to investors to raise money. Okay. Issued means sold to investors. Outstanding means the investors still own them. Okay. Well, who else can own them? The corporation. So issued and outstanding simply means the amount that have been sold to investors and how many of those shares are still owned by investors. So in this case, all 100,000 that have been issued are also owned by investors. But look what happens. In February, Mead acquires 4,000 of its own shares at $8 a share. So these 4,000 shares are going to be considered treasury stock. 4,000 shares at $8 a share means they paid $32,000. Treasury stock gets debited, cash gets credited because they use cash to buy it. Okay. So how does this treasury stock come into play? This is important. You need to know how to read this. Look at the Mead balance sheet now. We still have our common stock listed, $5 par, 400,000 shares have been authorized. We know that this company issued 100,000 shares. However, only 96,000 of those shares, of these 100,000, are outstanding, owned by the public. Why? Because 4,000 are owned by the company as treasury stock. So these are important things to know. Authorized shares, issued shares, outstanding shares, treasury shares, all very important concepts to know. Okay. Learning objective 3 is really about, it introduces you to cash dividends. That's the only type we're going to be looking at. There are obviously other types of dividends, but the cash dividend is the most common and something you should know about. Remember, a dividend is when a company decides to share a profit with its owners. Okay. Overwhelmingly, when a dividend is announced, it's usually going to be announced as a dollar amount per share, which means that if you had a company that announced a dividend, it would be, in essence, something like this, 10 cents per share. Okay. So that means for every share of ownership you have, you will get a 10-cent dividend per share. Now, if you own one share, that's 10 cents. You own 10 shares, it's $1, right? You have 100 shares, it's $10. So either way, it's 10 cents per share times the number of shares you have. Okay. Sometimes dividends are expressed as a percentage of par. That's usually what happens with preferred stock. Common stock, it's very similar. It's very common to just tell you what the amount is per share. Now, what's important to know about dividends is only the board of directors has the power to declare it. They're the only group in the corporate structure that has the power to declare a dividend. Nobody else can. They cannot declare a dividend unless A, they have retained earnings. Okay. Matter of fact, it's illegal in some states, if not all states, to declare a dividend without any earnings. So retained earnings has to be there, so they have to have profits. And they have to have enough cash to pay because they're promising the owners a cash dividend. So they have to have the cash to keep that promise. So those things have to be met before a paid cash dividend can be paid. Things that you have to know, we'll just call it the 3 dates that you have to know with this. The very first day, so here's the month of December and here's the month of January. The first date you see that's in white here is the date the board of directors announces the dividend. We call that the declaration date. The declaration date basically is a time where the board of directors promises a dividend to their stockholders. At that time, of course, since they've already promised the owners a dividend, they've created a liability for the company. They have a dividends payable, which you haven't learned yet, but that's an account. So the declaration date is important and accounting needs to get done. Who is going to get the dividend? Well, that's what the record date is for. The record date is basically it's a date where the company gets a record of all their owners and the number of shares they have. Now, just for you to know, the stock market in of itself is very busy. There may be hundreds of millions, if not billions of shares traded every day. Believe it or not, there are companies, and that's exhausting to think about it, there are companies who specialize in the record keeping. In other words, there are companies that keep track of who the owners are and how many shares they own. And they do that every single day. The official name of those companies are called a transfer agent, but they are basically record keepers for corporations who have stock. So at the end of the trading day on the 22nd of this month, the corporation will get a record of all the shareholders and how many shares they have at the end of that day. These are the folks that are going to get the dividend. Notice that it takes them a while to set all that stuff up. A few weeks, in fact. Okay. It's a lot of checks they got to write. The last date to know is the actual pay date. The payment date is when they literally send out the cash or the checks. Okay. And again, it takes them a few weeks to get that set up because they have to literally have records of who owned it, how many shares, and do the calculation of what their check's going to be. Okay. So it just takes time. So the pay date is when they actually pay that liability off that was announced here with cash. 3 very important dates. As important as you see here. Here's an illustration. There's a company Media General. They declare a 50-cent dividend per share on 100,000 shares of stock. Okay. Dividend is not paid until the 20th of January to stockholders who are on record the end of the day, 22nd. So the first thing that has to get done is that dividend that's been declared is going to set up a payable on the account of the company because now they owe the stockholders money. That's a dividends payable. Debit to cash dividends. What happens on the 22nd is the company will get a record of all these owners. There's no transaction here, so there's no entry that's needed. However, when they pay it, the transaction is they've paid off the dividend, so they can take that away, and they're going to credit cash to show that that cash went out. And that's basically all you need to know about the dividends. Objective 4 talks about how stockholders' equity is reported and how it's analyzed. So this is also very, very important. First, let's go to a statement, a balance sheet statement of retained earnings for Groupon. So here, Groupon's balance sheet shows their paid-in capital common stock, paid in capital in excess of par for common stock. But they don't have any retained earnings because there's a lot of companies that start off. It's very common for companies to lose money before they become profitable. Amazon didn't make a penny for, I think, 7, 8, 9 years before they became profitable. Of course, now look at them. They're super profitable now. So when a company does not have any profits, they don't have any retained earnings. They have losses. to report. So that accumulated loss is what we call an accumulated deficit. So this accumulated deficit is basically the sum of all the losses that the company had over time. Okay. How does a company cover the loss? Well, with its common stockholders. So whatever the common stockholders put in, that's what's covering the loss of the company. Okay. Notice this company also has treasury stock that's reported here. Okay. Balance sheets can be quite detailed in this area of stockholders' equity. A couple of things I want to point out here. First is paid-in capital is always the first section. If the company has preferred stock, it's always listed first, and then common stock is listed. Again, not that many companies have preferred stock, so oftentimes it'll just start with the common stock. This particular corporation has preferred stock. They have a 9% preferred stock, $100 par. So this 9% tells you what the dividend is. 9% of $100 is what the dividend is on that preferred stock. $9 on every 100 and every share. So that's just a way to calculate that if you're ever asked. You won't be asked in my class, but you might. They had 10,000 shares authorized, so it's approved through that legal process. They issued 6,000, and all 6,000 are still outstanding, still owned by the public. Common stock has no par, but they have a $5 stated value. Again, this is important for the accounting, right? 500,000 shares authorized, right, legally approved. 400,000 of those have been issued, so they've been sold off. But look, only 390,000 are outstanding. Well, if you had started with 400,000 and you're down to 390, the other 10 must be Treasury stock. And there it is, Treasury stock listed there. Very important. Here's your paid-in capital in excess of the par values that you see here. Okay. Retained earnings is listed. Treasury stock is listed, etc. So it's important to sort of understand and read some of these things. And again, these words, authorized, issued, outstanding, treasury stock, very, very important to understand that. So a little bit of analysis here. What's important to owners? One thing that's important to owners is how much of their profit is being shared with them. That's a payout ratio. That should be blank. The payout ratio is simply the amount of cash dividends over the net income. So your dividends are listed in 2013 as 821. Your nil income, I'll just go to net income. Okay, Nelly. Your net income is 2693. What percentage is that? 30. So basically they are sharing about 30% of their profits with the company in 2014. In 2013, when you look at this particular fraction, dividends to earnings, about 29%. So very, very similar. That's a payout ratio. Okay, the amount of dividends that are paid out on net income. That's it. Very simple. This is a good ratio. You don't want something like, 70, 80, 90%. I mean, what are they keeping in? Remember, a dividend is the amount that they're sharing with you. What most owners want is for them to reinvest, put that back in the company, buy more assets, get more profitable. So sharing too much of your profits with the owners can be a problem, and it may not be sustainable. That's why a lot of companies had to cut their dividends last year when the pandemic started. It just wasn't sustainable to have a high payout ratio. Another thing that stockholders want to know is what's their return on equity? What's their return on equity? So return on equity for common stockholders' equity simply is provided as your net income over your average common stockholder equity. Now, again, most corporations do not have preferred dividends. So about 92% of the time, this is going to be zero, like it is in Nike here. No preferred stock, no preferred dividends. So it's often your net income divided by your average common stockholders equity. So here for 2014, you have income of 2.69 billion divided by your average equity. That's these two numbers averaged, about 11 bill. So that's a 24.6% return on equity. That's really good. Anything in double digits is really good in my view. 2013 numbers, they had a $2.47 billion profit. Their average equity of the average of those two numbers, about 10.7 billion. That's a 23% return on equity. So again, both years, very, very good. The fact it's getting a little higher is even better. Okay. So learning objective 4 ends with a little bit of analysis. Again, return on common stockholders equity, your net income minus your dividends on preferred stock divided by the average equity. Okay. So for 2017, net income minus dividends on preferred stock divided by average equity. It's easy to average when the numbers are the same. 2016, same formula over that. So what do you get for averages? Well, for 2016, it's 20%. For 2017, 25%. So excellent return on equity for both of these years. And that is chapter 11 in a nutshell. How you feeling?